U.S. authorities are going after another European bank. New York State is suing Barclays over alleged fraud in the marketing of its dark pools. The bank runs one of Wall Street's largest dark pools. According to a complaint filed yesterday by New York Attorney General Eric Schneiderman, Barclays falsified marketing materials to hide how much high-frequency traders were buying and selling. Barclays is now said to be losing its dark pool trading customers. So how did the government build its case? And are there more like this on the way? Joining me right now, New York Attorney General Eric Schneiderman. Welcome, Attorney Schneiderman.
Thank you. Glad to be here.
Let's talk about this case. First of all, how did this come to be? How did you begin this investigation?
We started looking at issues related to high-frequency trading and firms that did business with high-frequency traders beginning of last year. And we've had several matters where we have dealt with the issue of early release of consumer confidence surveys and corporate earnings. And most of the time when we've confronted market participants, they've changed their behavior. We haven't had to sue. In this case, we discovered a pattern of fraud at Barclays in connection with its dark pool that over the last really 6 months or so, and some whistleblowers came forward from who had been insiders and brought us some documents and gave us testimony.
There was one in particular, right, that said that he tried to do something. He apparently was let go after having alerted some clients to the issue?
He refused to alter data. One of the things Barclays was doing was changing the data and misleading clients about how many of the trades were actually filled in Barclays' own dark pool. They were saying they had all this elaborate propaganda saying, oh, we go to whatever market is best for the client. We always go for the best price, the best fill. And in fact, the data that this director was preparing for a big institutional investor showed that 75% of all the trades were filled in Barclays' dark pool, suggesting they weren't really getting the best results for the client.
So they were taking it to themselves because, you get compensation, right, for having done the trade yourself.
And we now know that they were also allowing high-frequency traders access. So essentially, they were attracting fish into their pond with the promise that there were no predators, but they were inviting the predators in too. They told this director, you got to change this number from 75% to 35%. Out and out lie. He refused to do it, and he was fired. So several whistleblowers have come forward, and it was a case where we understood the fraud to be ongoing, and we proceeded quickly to bring the complaint because we have documents as recently as a couple of months ago showing, even in response to your press reports and my comments about high-frequency trading in March and April, the people inside Barclays saying, hey, there are all these reports out there. Here are some talking points to rebut them. And it was a bunch of more misleading information. So it was an ongoing fraudulent scheme.
But just to point out what they have said, Barclays issued a statement saying, we take these allegations very seriously. Barclays has been cooperating with the New York Attorney General and the SEC and has been examining this matter internally. The integrity of the markets is a top priority of Barclays. Have they been cooperating with you enough?
Well, no, we subpoenaed their records, and we got some production, and some production was more difficult to come by, and we filed a lawsuit against them. So the facts of the complaint really speak for themselves. In addition to the deception we just discussed about what portion of their trades were being filled in their own dark pool, we also discovered pretty blatant deception about the amount of high-frequency trading that was going on in their dark pool. They repeatedly represented to customers and investors it was less than 10%. It was really de minimis, and their internal numbers show that it was much greater than that. In fact, they were trying to lure high-frequency traders into their dark pool by offering them informational advantages, giving them information. Essentially, the HFTs were trading at no cost in Barclays' dark pool. So it was misrepresentations about the predatory nature of the trading in the pool. And these are their terms: predatory, toxic, aggressive traders. They had a rating system that they touted called the liquidity profiling system. And it was really a sham. And one Barclays director used the word sham in describing it.
Let's back up for a minute for the viewer who doesn't understand, for example, what a dark pool really is. I mean, the defense of the banks is that they would say we need these dark pools for clients who need to do very, very big trades and don't want people front-running those trades. So it gives you a certain amount of anonymity and secrecy in putting a large block of stock on the market. and so therefore doesn't have such an influence on the price. Walk us through what a dark pool is and why you see them as a problem now.
Well,
and maybe not necessarily a problem.
We're not condemning all dark pools. We're just saying that if you have a dark pool, and as you said, if I want to buy 20 million shares of Facebook, if I start buying in an open exchange, everyone can see that I'm buying, the price will go up and move away from me. So the theory of a dark pool is that I can buy there and the rest of the market's not going to see that I want to make such a massive purchase. The problem is, in this case, that Barclays was misleading its investors about what was actually going on in its dark pool, the degree to which it was filling orders in other venues where customers could get better prices, and the fact that they really were attracting predatory traders. And again, this is Barclays' own internal terminology. They talked about toxic, predatory, aggressive traders. They misrepresented the amount of that trading in their dark pool. It was as though they were attracting the fish into the pond and then giving fishing licenses to the HFTs.
So if I'm a client at Barclays and I want to buy a very large amount of stock, or sell a large amount, I would go to Barclays and they would say, okay, we would do this in a dark pool, and they should theoretically be using any dark pool, not just their own?
Well, what they represented to investors was that they would look, considering all the circumstances, the need to maintain some privacy, but also where you could get the best fill, where you could get the best order. Their marketing materials repeatedly represented, as all exchanges are now electronically linked, that they would go to the best exchange. When the data was assembled and it came out that 75% of the trades were in their own dark pool, which is a number that's impossible to achieve if you're actually searching for the best price for every customer, they directed one of their employees to falsify that data and have it say 35%.
What's in it for them, Eric? I mean, if they theoretically stand to make more money, right? If the trade goes through, if the block goes through their own dark pool as opposed to farming it out to someone else's.
Yeah, it was clear from the documents we got and the testimony we received that they had a project in this particular division, the equities electronic trading division, that they called it the franchise. The dark pool, they wanted to be the largest in the United States. They wanted to attract a lot of people into it. Obviously, if you have a big dark pool, you save because you don't have to pay fees to other exchanges and other banks. And that was one of their projects. So they attracted people in with marketing materials that suggested this is the safest place you can do business. There was de minimis high-frequency trading, de minimis toxic activity, and they represented that through this liquidity profiling system, they would throw out traders who were overly aggressive. They never threw out one single trader, no matter how predatory their conduct was.
What is your sort of gut reaction here? I mean, how prevalent is this on Wall Street? What you've seen at Barclays, is this happening at other institutions?
Well, this is a pretty flamboyant example of out-and-out fraud against your investors. We don't believe that's happening across the board.
Although you can understand a lot of banks might be incentivized to have these trades happen in-house as opposed to out-of-house.
And that's fine. You just can't lie to your customers and say, oh, 6% of the trading here falls into these categories that are predatory or toxic. These are Barclays terms, when it's in fact 25 or 30 or 40%.
Have you gone through the numbers? Have you looked to see just exactly how many trades really were happening internally versus externally?
We've got their own documentation. We know that they knew the numbers.
And what's the percentage?
That they were in their dark pool. In excess of 75% of all of the trades for all the customers they took in were executed in their own dark pool. And when they saw that number, they knew it would scare away institutional investors. So they actually, after they fired the guy who wouldn't reduce the number to 35%, they presented this false information to the investor anyway. And that's why that was one of the things that caused us to feel that we had to move rapidly to file a complaint.
So what kind of fines do you anticipate will be imposed, and what would you like to see to discourage this kind of behavior at Barclays and any other institution out there?
Well, it's too early to tell. We just filed the complaint. We now have a period of discovery. Part of it depends on what kind of injunctive relief we get or what Barclays does. If they immediately clean their act up, that affects our view of the fine they should pay. But we're in court now, and we're looking forward to moving ahead now that we're in front of a judge.
All right. Well, Eric Schneiderman, thank you very much for joining me and explaining the complaint. That's the New York Attorney General, Eric Schneiderman.
Thank you.